In this part of the lecture, we will discuss the most important aspect, that is selection of mutual fund. When you make the decision to invest in mutual fund, your initial step should be determining the category of mutual fund that aligns with your investment goals. This depends choosing whether you wish to explore equity funds for potential growth, debt funds for stability, or hybrid funds for balanced approach. The selection of appropriate mutual fund type depends on three important factors. Firstly, your age plays a significant role in this decision. Secondly, the time frame you have in mind for your investment is another crucial consideration. Lastly, your risk tolerance forms the third vital factor. Let's explore these factors individually to gain better understanding. The slide shows the graph of age versus type of mutual fund you should choose for investment. The first phase is accumulation phase. It is the starting point of one's career, as young individuals have longer time horizons, fewer responsibilities, and higher risk tolerance levels. Their asset allocation should be aggressive. Accordingly, investor would have higher exposure to riskier investments like equity funds. It may include mid cap funds and small cap funds. The next phase is consolidation phase. It represents by middle-aged individuals who have a higher responsibility. Hence, their risk appetite is moderate. At this stage, investors should choose the moderate approach and use the balance model of equity and debt so that they can preserve their wealth. Here one can choose hybrid funds or large cap equity and debt funds. The last phase is distribution phase. It is the years of post retirement where you don't want to take any risk. So at this stage you should choose the debt funds where the capital is preserved and you can get regular payouts. This slide illustrates the recommendation of mutual fund categories based on various investment time frames. If your investment horizon is less than 1 year, opting for debt funds is advisable as they prioritize capital protection. For medium term investment spanning to 3 to 5 years, the preferred choice would be hybrid funds, a blend of equity and debt funds. Conversely, for investing period exceeding 5 years, equity funds are recommended. Now this is the illustration with some actual values. This slide presents an illustrative scenario for retirement planning over 25 years period. If you are an individual begin investing rupees 10,000 monthly in equity fund from the age of 25 until you turn 45. This investment potentially accumulate around 92 lakhs, assuming conservative returns of 10%. Notably, high performing equity funds can yield returns exceeding 15%, and from 25 to 45 you can invest in equity funds by taking some risk that will give you better returns. As one reaches middle age, adopting cautious investment strategy is advisable. During this phase, maintaining 10,000 monthly investment in debt fund and systematically transferring 1 lakh rupees per month to the debt fund from the accumulated 92 lakhs. You can use a systematic transfer plan where you can give instruction to mutual fund that transfer 1 lakh rupees from my wealth to the another fund. If you do this by next 15 years, by the age of 60, you can build a corpus of 3.5 crores. 60 is a typical retirement age in India. With a prudent approach and investment in sound debt fund, it is very feasible to withdraw 2.5 lakhs rupees per month as a pension sustaining until the age of 80. Here I am assuming the returns from debt fund as 8%. In essence, by consistently investing in 10,000 rupees monthly from age of 25 to 60, it is very much possible to withdraw pension of 2.5 lakhs per month after age of 60 or after your retirement. Here I am assuming very conservative returns like 10% for equity and 8% for debt. Actual returns are more than this. Now this slide illustrates the mutual fund category selection considering both risk and tolerance and time duration. For individuals seeking short-term investment with minimal risk, liquid funds are suitable. Conversely, for those who are willing to accept substantial risk for potential high returns, arbitrage funds can be a good choice. For investment horizon extending beyond 5 years and you are open to moderate risk, the multi-cap fund category becomes appealing. This choice provides stability through large cap fund investment while incorporating the potential for favorable returns by including mid cap and small cap holding. So large cap fund will give you the stability and mid and small cap will give you the higher returns. Now once you have selected the mutual fund category based on factors like your age, time horizon and risk tolerance, the next step involves selecting a specific mutual fund scheme. Each mutual fund category typically presented a wide array of schemes available in the market. In upcoming section, we will discuss the criteria that should guide your selection of scheme once the appropriate fund category has been identified. So once you identified the large cap fund, there are so many large cap schemes available in the market offered by different AMCs. Now at the start, you should keep these selection criteria in mind while selecting a particular scheme. So these selection criteria are returns, entry and exit load, comparison with peer, means funds performance with its peer schemes, comparison of funds with benchmark. Benchmark is Nifty 50 or let's say the mid cap index or large cap index. So if you are investing in large cap index, then you should compare the funds performance with large cap index. Then expense ratio and consistency of returns. So let's discuss these things one by one. Here is the brief explanation of each of the points regarding the selection of mutual fund. So the first point is returns. The returns of mutual fund should align with your investment objectives. If you are aiming for a long-term growth, the fund's historical return should demonstrate steady growth over similar time frame. The next is entry and exit loads. Entry refers to the fee charged when you invest in a mutual fund, and exit load is a fee levied upon early redemption. Be aware of these fees as they can impact your overall returns. Some funds have exit loads if you withdraw before specified holding period. Coming to the equity fund generally levy exit load if you redeem your investment within 1 year of time. After 1 year, there is no exit load in case of equity funds. For debt funds, there is no exit load. The next point is comparison with peers. Comparing the performance of mutual fund with its peers is very important. It will give you a comprehensive view of the scheme you have selected. It helps you to assess how the fund rank within its category and whether it consistently perform well. So if you are buying a mid-cap fund, you should compare the scheme you have selected with all mid-cap funds available in the market, at least some major mid-cap funds available in the market, so you can assess whether your fund is doing well or not in comparison with the funds in the same category. The next point is performance against benchmark. A mutual fund's performance should be evaluated against relevant benchmark index. A benchmark index is a standard against which the performance of mutual fund can be measured. For example, a mid-cap fund's performance should be compared with the performance of mid-cap index. Similarly, performance of a large-cap fund can be compared with large-cap index. This comparison offers insight into how effectively funds management is generating returns relative to the market. So these indices are the picture of a market. So if market is growing at 20% rate per annum, then your fund should grow at least 20% per annum, or rather should be more than 20% per annum. So comparing with the benchmark index is a crucial point. There are a few more points. The next is consistency in performance. A reliable mutual fund should demonstrate consistent performance across market cycle. It's important to evaluate funds performance not only during the period of growth but also when the downturns of the market. Assessing mutual funds 3 and 5-year return can offer insights into its consistency over varying market conditions. The last but the important point is the expense ratio. The expense ratio represents the annual fee charged by the fund for managing your investment. A higher expense ratio can eat into your returns. Generally, the lower expense ratio is more favorable. An expense ratio around 1.5% is often considered reasonable and can help you to maximize your potential returns. By incorporating these factors, whatever we have discussed, into your mutual fund selection process, you can make well informed decisions that they are better aligned with your financial objectives. There are few more criteria like beta ratio, Sharpe ratio. Those who are interested in learning those criteria, you can Google it. When considering investment in mutual fund, there are two primary approaches to choose from. Firstly, you can opt to directly purchase mutual fund units from the asset management company, that is AMC. Alternatively, you have the option to purchase these units through intermediary, often referred to as an agent. When you decide to buy mutual fund units directly from AMC, it is categorized as direct plan. On the other hand, if you choose to buy these units through an agent or intermediary, it is categorized as regular plan. Direct plans are bought from AMC and no intermediary is involved. You can invest in direct plans online by going to AMC website or by visiting AMC or the registrar's office in your city. Since mutual fund distributors are not involved in the direct plan investment, the asset management company does not have to incur distribution expenses. That is distributor's commission. As a result, if you compare regular versus direct mutual fund, you will find total expense ratio of or the expenses of direct plans are of course lower. Regular plans are bought through mutual fund distributors. Mutual fund distributor provides service like advising investors on which mutual fund scheme to invest in, submitting investors know your client, that is KYC document, to the registrar and transfer agents or AMCs, helping investors with the investment process like submitting application form, checks, etc. Ongoing services like generating account statements are offered by the agents. For these services, the distributors receive commission from AMC as long as you remain invested in a regular mutual fund plan. Of course, the AMC adds these commission to the expenses of regular plan. As a result, expenses of regular plans are higher than those of direct plans. Since expenses of regular plans are higher than those of direct plans, the NAV of direct plans are higher than regular plans. So in other words, your investment value after you have made your purchase will always be higher in case of direct plan compared to the regular plan. But here is one thing that you should remember, that agent can help you for the selection of mutual fund. So if you can select mutual fund on your own, okay, so if you are good at it, then you can save a lot of cost, at least 5%. Here is a presentation on one example. Consider a scenario: a 25-year-old individual aiming to invest in mutual funds. Given the circumstances, the most logical category to consider would be equity fund due to their promising returns. As the person has limited financial obligations and responsibilities, the risk tolerance of the person can be assumed to be relatively high. He can take high risk. This inclination towards high risk suggests a favorable path towards investing in large cap or mid cap funds. Small cap falls under very high risk category. Considering the investment horizon more than 5 years, both large cap and mid cap funds emerge as a best choices. This aligns with the individual's time frame, enhancing the potential for favorable returns. Additionally, since the individual is only 25 years old, he prefers not to receive regular payouts, but instead aims for capital appreciation. Therefore, growth option is chosen. Within large cap and mid cap fund category, specifically focusing on growth option, the market offers 50 different schemes. However, the question remains, how does one explore through these choices to select most appropriate scheme for the investment? The online platform mentioned on the slide offer valuable assistance in the process of fund selection. There are many websites that assist mutual fund selection based on the criteria we have discussed so far. I have mentioned few websites on this slide, but first two are my personal favorite. The first is Ticker Tape. The first website aids in primary selection of mutual fund. It provides foundation for identifying suitable fund. To assess the enhanced feature of this selection tool, you have to subscribe and pay fees. So let's see how this Ticker Tape works. So I am here, tickertape.in. Sector, this is equity. So let me go to the mutual funds. So this is mutual fund selection tool. You can see here on the left hand side there are filters available. So my filter is equity fund. Under equity category there are 23 funds. So if I see what are the options available, there are so many options, 23 options available here. Okay, so my inclination is towards large cap and mid cap fund. I will select large cap and mid cap fund. It will show you all large cap and mid cap funds available in the market. Now my plan is growth plan. I can select the growth plan. See, I can select the growth plan as I don't want regular payouts. The next criteria is asset under management. I don't care about asset under management. Here CAGR, that is compounded annual growth rate for 3 years. So compounded annual growth rate for 3 years, you can change this option and make it 5 years also. I will say high. Okay, so it will just show me the funds which are offering high CAGR. Now expense ratio should be low. Okay, for low it's just showing me one fund. For mid it's showing me large number of funds. Okay. Now you can add filters from this. So there are various filters like risk, then portfolio composition, percentage of debt holding, etc., etc. Different ratios like Sharpe ratio, beta ratio. Now you have number of funds shown on the website. These are the filtered funds. So if I sort it based on the returns, you can see here ICICI Pru large and mid cap fund had offered 31.61% returns in last 3 years. HDFC large and mid cap fund has offered 31.5% return in last 3 years, and so on. So these are the various funds available under this category. So if you click on particular fund in snapshot, you can see the different type of different parameters of the funds. So these are the different parameters of the fund. Now here the information available is little less, because if you want to have more information you have to subscribe this tool. Now I will use another platform that is called as Value Research Online. I will go to this Value Research Online and I will search for this fund. Of course you have to register here, and once you register here, all the information is available to you without any charge. So this is ICICI Prudential large and mid cap fund direct plan. Okay, so these are the 3 years return. Now if you go here returns, you have option to select from, I will say, let's say 5 years. So you can see here the graph. The blue line is ICICI Prudential Mutual Fund. This is S&P BSE large and mid cap index and equity large and mid cap index. So you can see here the line is, this blue line is always above the other two lines, means the ICICI mid cap fund is offering returns over benchmark for last 2 years. Okay, so there is no such consistency. If you look at this from 22 onwards or from 20 onwards or in 2021, the large cap this fund has offered returns which are less than the benchmark index. So I may consider another fund. So this is the detailed return over time, the best and worst period of fund's performance. This is the calculator. So if you invest certain amount in the fund, what would be its value, and so on. Now you can even get the portfolio. This is the asset allocation. 94% is to equity and 1.6% to debt and 4% is to cash and cash equivalent. And this is the sector wise holding. You can see here financial sector holds a lot, energy sector, then automobile sector, healthcare sector. And if you go further down, you can see the top holdings. So the topmost holding is 6% of ICICI stocks, then 5% of HDFC, then around 4% Infosys stocks. So the percentage of investment made by the fund in ICICI Bank is 6%, and so on. There is a lot of data available. As you explore through these websites, you will understand it more. So I recommend you to go to these websites and search. So coming back to our presentation, there is one thing that you should know called as riskometer. SEBI, which is like governing body for investment market in India, has introduced a helpful way for people to invest in mutual funds. They have asked all the companies that manage mutual funds to use something called as a riskometer. This plan helps people understand how much risk is connected to a specific mutual fund. The riskometer works like a measuring scale. It has different levels. Each mutual fund gets placed on this scale based on how risky it is. It helps us to see how safe or risky the mutual fund could be. So this tool helps people can make better choices when they invest in mutual fund. It shows us the possible risk and we can decide if we are comfortable with those risks based on our goals and how much risk we are okay with. So you can see here the different type of risk are shown, whether the fund is falling under the category like low risk, low to moderate risk or very high risk. So for every fund on the website of AMC you will find this riskometer and you can decide whether you are comfortable with taking that much risk. Now we will discuss about systematic investment plan. Systematic investment plan is a smart way to invest money in mutual fund. SIP, it is called as SIP, systematic investment plan, short form is SIP. SIP is often thought of as a tool to build wealth over time. It brings two important things to the table: compounding and rupee averaging. One of the biggest advantage of SIP is that it helps to reduce risk. So how it reduces the risk? Just take a simple example. When you invest a fixed amount regularly, you are not putting all your money at once when the market is high. Instead, you are spreading out your investment. This can help minimize the ups and downs, and that is the inherent property of stock market. So you are not purchasing something at a time, you are spreading your purchase over the period like 1 year, 2 year. So in a nutshell, SIP is like money growing engine. It lets you benefit from compounding and rupee averaging while lowering the risk of your investment. It's a great way to gradually build wealth over time. So SIP is something like you are purchasing some grocery. When the grocery rates are low, you buy more. If the grocery rates are high, you buy less. Systematic investment plan is a method provided by mutual fund that allows investor to contribute smaller amounts at regular intervals rather than investing a large lump sum at once. This approach makes investing more accessible and manageable for individuals with varying financial capacities. So you can start SIP with just 500 rupees. SIP offers flexibility when it comes to the frequency of investment. Investor can choose to contribute on a monthly, quarterly, semi-annually or annual basis, depending upon their financial circumstances and preferences. This frequency can be tailored to align with investors' income flow and financial goals. Now, how it works? Let's see. When an investor opts for SIP, they commit to depositing a fixed amount of money at regular interval into a selected mutual fund scheme. This amount is deducted automatically from your bank account based on the chosen frequency. For example, if an individual chooses a monthly SIP of 5,000 rupees, the specified amount will be deducted from their account every month on a specific date. Now let's see some advantage of SIP. The first important advantage is rupee cost averaging. Rupee cost averaging is a strategy where you invest a fixed amount of money at regular interval like through SIP. When the price of mutual fund units is low, that is net asset value is low, you get more units for your money. When the price is high, you get fewer units. This helps average out the cost of your investment over time. It is like buying more groceries when they are on sale and fewer when they are expensive. The next is affordability. As I told you, you can start SIP with the amount as little as rupees 500. The next is convenience. SIP is hassle free. Once you set it up, it's also possible in online mode. To the internet, you can set up your SIP. You don't have to go to the bank. The money gets automatically deducted from your bank account on chosen date. So you don't have to remember to invest every month. It happens automatically. And you can choose SIP date as per your convenience, like 1st, 5th, 2nd, 10th, 15th, 17th, 20th, 28th, 30th, whatever you like. The last but the very important advantage is power of compounding. Compounding is like magic for your money. When you invest to earn profits, those profits earn more profits. With SIP, you keep adding money regularly, and each addition has a potential to grow over time. The longer you stay invested, the more powerful this compounding effect becomes, that we have seen in one of our previous lectures. Now these points highlights why SIP is such a popular and effective way to invest. It's easy on your wallet, convenient, and leverages the power of compounding to help your money to grow continuously over long time. Now let's see an example of rupee cost averaging. Imagine there is one Miss Veena is investing 1000 every month through SIP in a mutual fund. She buys units on 10th of each month. So the SIP date set is 10th. So money will be deducted from her account on 10th of every month, and it will be put into the stock market. Like, of course, she will buy units of mutual fund from that 1000. The table displays the net asset value on each purchase date and corresponding units allotted to her for 1000 rupees. Now here one point you should note, if NAV of your fund is 2000, you will get zero 0.5 units. So you can even get fractional units. It is not like that you will get whole number units. Okay, it's not a physical entity. That's why it is also offered in fraction. So if NAV of fund is 500, and if I am investing let's say 100, it's not, of course 100 is just example, minimum you have to invest 500. So you will get 0.2 units. Now, if we calculate the average NAV over 12 months and compare it with the average purchase cost, okay, which is the total amount invested divided by the number of units allotted, that's a purchase cost. We notice an interesting pattern. The average NAV consistently turn out to be higher than the average purchase cost. In other words, the average cost per unit is always lower than the average NAV per unit, regardless of how the market is moving. In short, your current value is higher than your average cost. So this highlights the essence of rupee cost averaging. By consistently investing in fixed amount of every month, Miss Veena is automatically buying more units when NAV is lower and fewer units when it's higher. So over time, like 2 years, 3 years, this averaging effect cushions the impact of market fluctuations and can lead to more stable and potentially rewarding investment journey. Remember, SIP is the best option for making investment in mutual fund. So start your SIP today. Now this slide shows the steps in investing through SIP mode. It's very easy and you can understand it and work accordingly. Now this is one more illustration. This illustration on this slide vividly demonstrates the remarkable potential of SIP in wealth creation. Let's take a hypothetical example involving Miss Aishwarya. Suppose Miss Aishwarya start SIP with an initial investment of 20,000 rupees. followed by monthly contribution of 10,000 rupees into mutual fund scheme that offers an average return of 10%. Okay, so initial investment is 20,000 rupees and every month she is putting 10,000 rupees. The returns are 10%. She continued the same over the span of 25 years. After 25 years, the outcome is truly striking. You can see on the slide. Miss Aishwarya has accumulated substantial sum of 2 crores 83 lakhs, close to 3 crores. It is important to note that in this scenario, a conservative return of 10% is assumed. This makes the projection very modest. However, if you look at the image on the left hand side, you can see the mutual fund scheme with exceptional performance record delivering returns exceeding 20% over the past decade. Okay, so if you consider even 15%, the actual outcome would be significantly greater than those projected. The potential wealth accumulated might be at least twice the depicted figures, and if you could get 18% like that, you would be accumulating 6 crores. This showcases the astonishing impact of favorable returns and the immense power of SIP as a wealth building tool. So this is all you need to know about starting with mutual fund investment as a beginner. If you want to explore further, you can learn about different numbers like beta ratio and Sharpe ratio. These numbers can help you to choose the right mutual fund scheme. Just a reminder, the best way to build your wealth through mutual fund is by starting SIP. I suggest you start SIP in a large cap fund right away. I am confident that by the end of year, your investment will have grown nicely, giving you returns around 12%. So thanks for paying attention and we'll see you in the next lecture. Thank you.